Niranjan Avasthi here from Edelweiss Mutual Fund. Welcome you all. You would be surprised to see me. Actually, Deepak Jain, who is our head of sales, was supposed to do this, but he got some emergency due to which he could not be here. So today we have with us Trideep Bhattacharya, our CIO for equities, and of course the fund manager for the fund which we will be discussing today, which is Edelweiss Focused Equity Fund. Just to give you a background and history about this fund, we launched this fund exactly a year ago. July is the month where we were meeting you all, talking about this very unique strategy, which we will just discuss. And markets were there then, quite volatile. And we got a good response from many of you, and your investors showed trust. As we speak today, since inception, the fund has returned almost 18.5% to its investors. At the same time, markets are roughly up almost around 50% a good alpha, and I can see smile on Trideep's face. And we always, when we were out, we were speaking to you, we mentioned that this fund will have some sectoral skew. It will be quite different from what it is in this entire focused fund universe. And so today we are here to discuss more about it, give you a kind of report card of this fund, what we have been doing, and also currently what we see, how the fund is positioned. So welcome, Trideep.
Thanks, Niranjan. Thanks for the kind introduction. It always helps.
Right. So before we well into the fund, Trideep, it is always good to talk about market first. And what a better day to talk. Yesterday we just kissed 20,000 or about to kiss 20,000 on Nifty. So your views on the market, and then maybe we can proceed towards the fund.
Yeah. And I think overall, I would say that from an equity market standpoint, to cut through the chase, I would say that we are basically dealing with a fair value market. I think when I look at the valuations across large, mid, and small, on an average, I don't find mispricing happening. But I do find the pockets of value. And I think that's where basically what we stand for, which is overall stock selection and making a difference that way. Over the year that we just completed, the 300 basis points alpha, net of fees and all the kind of nice stuff goes on to show that even a multi-cap portfolio, as long as we do focused investing, it works. If investors, potential investors and distributors would know that when we sort of started marketing this fund, we talked about how focused investing works, how 97, 98% of the returns of even a large developed market in S&P kind of were driven by a few stocks. And I think so far, if the year has anything to go by, we have kind of proved that to ourselves, and I think we can prove it on and on. But I mean, skipping back to equity markets, basically overall, we think, as I was saying, that we started the year with an hypothesis of recession before rebound. And if you look at the first 3 months of the year, the data points coming out of globally as well as locally kind of pointed to rising interest rates, rising inflation, couple of bankruptcies globally. So it was fairly atrocious to deal with. Gradually post-March, around April, May, I think we got an idea that rates are closer to peaking. Even though when we wrote about recession before rebound, nobody really kind of, then they thought that rates were peaked then. And we said that, no, we have a few more months to go. And that is kind of by and large worked that way. As we head towards the year end, I think we are gradually coming closer to the rebound part of the hypothesis overall. And I think therein, which is the medium term view, we are quite positive with regards to Indian equity markets because of, the themes that we like, which include the private sector capex, the lending financials, the real estate, and which I'm sure we'll kind of, go into details to not to steal everything in one go. But net, we are quite positive from the medium-term standpoint. We were worried about the hiccups that the start of the year would go. I think by and large, we have seen that. Maybe we have got a few more to go through as we head towards the year end. But this year, by and large, would be the time where investors should kind of spend time accumulating. And for the better part of last 6-9 months, it's sort of worked out that way. So that's where we are. In a nutshell, dealing with, as we speak, a fair value kind of market, hinging on pockets of value. And we think that we are able to still find them, which means that markets are not still atrociously expensive overall. So that's how I would stop.
Right. Trideep, just one point, you just mentioned that valuations are not, you know, uh, quite expensive, but they are maybe around fair value. What are the reasons for it? Because we have seen a good run up in the market, but is it because the underlying earnings have been strong? Can you just throw some more light on the earnings part as well on the market over the last 1 year?
Sure, Niranjan. I would say that if you look at, on one hand, while we can celebrate, as in the media channels that we are hitting or about to hit all-time high, but a more somber way to look at it is that if you go back October, November last year, we were broadly at the same level, give or take 4 or 5%. So in other words, markets haven't gone anywhere in the last 12 to 15 months. But equally at the same time, if you look at the earnings of the companies that we are invested in, they have gone up anywhere between 20 to 35%, depending on which sector and which company you look at. Which means that the valuations today, 1 year forward, are a lot more palatable as compared to what they were about a year or so ago. So the investing environment that we are into is a lot more saner today than what we were before. Even though versus the average 10-year sort of a valuations, we are probably one standard deviation on the higher side, which means we are slightly, which is why I said that we are broadly fair value. But if you look at earnings estimate and the earnings growth picture, that looks fairly robust, which is why I feel that overall, with the right stock selection, we can still generate alpha in the market.
Fair point, Pradeep. Now let's get into the topic for today, which is a deep dive into our focused equity fund. Let's start right from the basic when we started the NFO. We went out and talked about this fund. And one point which a lot of people and especially our distributors liked was how we, had a very unique investment strategy as far as the portfolio construction is concerned. We had 3 themes and so on. So why don't you talk about those 3 themes and what was the thought behind coming up with these 3 themes in this fund, which is very unique in this category?
Indeed. So I think, and I was going through the slides that we sort of talked about at the time of NFO. And I think there were 3 really points, salient points. Of course, it's a focus strategy. So we were talking about 25 to 30 stocks. We talked about that we'll be benchmark and sector agnostic. We also said there will be a multi-cap sort of approach. With those motherhood statements, the areas that we thought would be focused on were selected a bit differently, as you recall, Niranjan, when we sat together, than how we kind of think about most of the funds. And the way we thought about those themes, it's interesting for investors to know, which is why I am kind of giving a bit of background, is that if you look at most of the funds that are there in the market, they're trying to play the economic theme, whether it's, a sectoral theme that we talk about, or for that matter, something that relates to Indian economy at the current juncture. The problem with following those, and there's no problem. I mean, one can always do that, many ways to skin the cat. But a better way we thought could be, or one of the better ways to skin the cat could be, that if we were to think about where India is in its evolution in the grand scheme of things globally. And when we sort of set that framework, 3 themes actually came out in my head, and we discussed internally, and kind of it resonated well with everyone. The first one was basically brand. Now, of course, when we talked about it, we were probably kind of, standing out there. But today, when Apple talks about it, people listen, right? So the reason I say so is, Apple opened its first store in India in 2000, in just about a month or so ago, when kind of, whereas they opened a similar store in China almost a decade or so ago. Now, what is the commonality between the two? If you ask me, I would say that, the per capita GDP for both of these countries were round about the same levels, where discretionary consumption towards brands picks up materially. This was also our thinking why we thought that with regard to where the Indian economy is in its evolution, brands is certainly a place that we want our investors to get exposed to. And we did overall in the grand scheme of things. So that was the first theme that we talked about, that we would invest in brands which can play, or Indian brands, the homegrown brands, wherein we can play the branded consumption over a period of time. The second area that we talked about was basically with Indian economy where it is. We thought that always India economy would actually kind of would see a good amount of operating leverage flow through. As the different sectors do well, the operating leverage kicks in. The best way to make money for them is to own the market share gainer. So that turned out to be our second theme. That if you look at the medium term, go beyond the valuations being high in the near term or low in the near term, and look at 5 to 10 year horizon, market share gainers is a good way to sort of play the cyclical upturn or where India is on a structural basis over the medium term. And the third is basically innovators, so disruptors. I'm sure all of us would realize that innovation or disruption is the name of the game. Even autos as a sector, which was a pristine sector till recently, has been kind of seeing good amount of disruption once in the last 100 years. Likewise, as I ramble through the sectors in my head, I can't think about any single one where we haven't seen disruption. I mean, the most recent being like ChatGPT. Niranjan, you would be pleased to know that while computers took about 10 years to reach the first million mark, ChatGPT took about 5 days to do so. So that's the pace of disruption that we're dealing with. So clearly, the beneficiaries of disruption in the context of the Indian economy turned out to be the third theme that we play. The where I would like to end with this same theme is today, when I look at the portfolio, broadly about 42% or 40% of 40 is brand, roughly about 25% is innovators, and roughly about 28% is basically the market share gainers. That's how the cookie crumbles, as people would say. That's how we are kind of oriented across different different subsegments.
Right, fair point. Uh, I'm not going to leave you at this, juncture when we talk about these three. I want to deep dive into each of them, Trideep. So let's start, which is all of your favorites, but one of your most favorites, which I know is brands. You've been, tracking brands. You've been, working in this space for almost a decade. While you gave a very good example of, how do you see Apple opening stores in India, that, correlation with the per capita GDP with China at the same time in 2008, a decade ago exactly. But there are, homegrown brands in our portfolio. So how do you see brands while picking these stocks or these businesses for, earning returns over the next, years and decades? How a strong brand, percolates to giving a good return in a portfolio, what it brings. And first is, how do you define a good brand? Because today, even 100 crore or a 200 crore company spends a lot on its marketing to, shore up the brand. But at what stage do you call a company a strong brand, and would you invest in that?
I think it's a great question, Niranjan. You are a good student of brands by yourself, so maybe you can add on when I say something. But here is what I would say: that basically, like any company, brands go through a life cycle. Um, you know, in the first instance is basically what we call as an emerging brand. Herein, the belief of the market at the same time of the investors are fairly low. People haven't seen the execution of the company, and hence are kind of skeptical about betting on them. If you recall, in an economy about 15 years ago, people used to hand over fist bet on MNC brands because they weren't sure about the Indian brand. Today, in every industry, you have an Indian challenger which is now contesting nicely with the MNC brands, and in some cases, have gone on to become the dominant brand in that category. So the first stage of the life cycle is basically the emerging brand, where the risk is high, but at the same time the return is also high. In the listed context, I would sort of put them in the mid or small cap category, wherein kind of, entrepreneurs have an idea. They've worked about in 10, 15 years in building the brand. But there we go. The execution is still untested in the listed world. We have a couple of them in our portfolios. But overall, what we find is over a period of time, as the belief factor grows, not only the earnings growth is faster than average. The average earnings growth in India would be maybe 15% or 17%. It will probably be higher than that. But what is the icing on the cake is the PE re-rating that they go through. This is the journey I'm talking about when an emerging brand goes on to become an established brand. This is a journey which, Fevicol, which is a company listed in the market by the name of Pidilite, and we don't own the company, and hence I give this example just to make sure that what we are saying here is not a recommendation. That overall, how the brand evolved over a period of last 30, 40 years, where where people used to go for the German brands in 90s or early 2000s, and now so much so that when we want an adhesive, we call it Fevicol. So the brand name has become synonymous with the category that they're in. That's the holy grail of brands that we have go through. Asian Paints is another company which has kind of gone through similar sort of transition. And finally, one portfolio name that I would talk about is Titan, which has kind of gone through a similar sort of a transition from, significantly practically nowhere about 15 years ago, where people used to go to the nearby shop to get their jewelry done. Now, definitely swear by Tanishq to kind of get their jewelry done, because Tanishq would be available in different parts of the country as well as globally. So, just to summarize what I said, basically brands go through the life cycle from emerging brands to established brands. If we can identify an emerging brand early in their life cycle, all we need to do is own them and kind of stay with them for a longer period of time to generate not only alpha but supernormal returns. Multiple portfolio holdings have gone through this, as I sort of rambled in my head. The companies that have done so, whether it is basically ITC, whether it is basically Oberoi's in the context of realty, or for that matter Titan, all of these across market cap have seen multiple bits of re-rating over multiple years, and I would say more to follow. That's how I would characterize the life cycle of a brand. Niranjan, anything you want to add?
Just one more question, because a lot of people, when we talk about brand, by default, we think about consumer brands or brands which we use in day-to-day life. So is it necessary that a brand has to be a B2C company or a consumer company, which, it is directly dealing with the investors? So because, in our portfolio, we do have some other companies. So
I think you are absolutely, it's a good spot. That brand doesn't necessarily have to be B2C, even though most common interpretation of brand is B2C. The classic example I would give is basically ABB. Now, if you look at ABB as a company, it's a B2B company. But if you go and speak to any corporate, which is the gold standard when it comes to, data centers, or for that matter, kind of, renewables, as they set up their plan, they would point towards ABB. Nobody gets fired for hiring an ABB owned switchgear, or for that matter, data centers overall. So it's a strong brand to contend with in the B2B domain. What that means is that it gets good amount of pricing power, and that's particularly in a cyclical sector like that of industrials or like that of B2B. Overall, having pricing power is the way to go about it. I could go on and on. Like for instance, another company that we have in our portfolio, which is basically Cummins. Now, when it comes to genset, the holy grail of gensets is basically Cummins, particularly in the high voltage segment. And at that level, you do need the kind of what you shall say, the reliability of the brand to kind of stand for itself. So brands are not only B2C but also very relevant in the B2B. Now, why is it? If I link it back to where India is, I would say that if you look at about 10 years ago, people used to make do with the kacha pakka or the simple brands or the unorganized brands, so to speak, that we will change the Chinese companies and this, that, the other. But as the corporates have now kind of become more organized, uh, in their tendency to go with brands has become higher than what they were. So brands can be B2B as well, and owning B2B brands can be very profitable over a period of time as well. Is the long and short of it, Niranjan.
Thanks, Trideep. I don't have anything to add. You have, elaborated so beautifully about brands, and it shows your love and your expertise in that area. And I believe, Edelweiss Mutual Fund will become a brand of choice for a lot of people.
Touche.
So let's move to our next, theme which we have, which is market share gainers. So what exactly do you mean when you talk about market share gainers, and what kind of businesses? Because, there could be market share gainers, simply put, it is a company which is gaining market share. So it could be from the peers, it could be from a market which is underpenetrated. So how do you define market share gainers, and how it transforms into higher returns for the investors?
Yeah. So I think, simply market share gain never happens. As a business person yourself, we work day in, day out. You design the marketing content, and when we go out talking to investors, market share gain happens after a lot of hard work. And it's a sum total of hard work which is being done over multiple years by multiple people as a team. But so the first place to be for a company is market share gain. Now, once you become, so let's think about a cyclical company where fixed costs are what they are, but the fixed costs don't change all that much. What happens when you start gaining market share, and if you have a sectoral tailwind, is that overall, all of a sudden, the growth rate catapults into a higher level, which is fine, but majority of that flows to the bottom line. The AMC industry is a classic example of that, where the number of people, if you look at the investment team, the number of people in an investment team to run 10,000 crores, which is where we are, or 25,000 crores where we are maybe about 15. The number of people that we need to run 50,000 crores will probably not be more than one or two higher than where we are today. So
Right.
the incremental revenue in the form of profitability gets down to the bottom line. The distributors who understand, who are listening to this, can appreciate this very well. Now, that is basically the holy grail of operating leverage, that the incremental top line flows to the bottom line. And that earnings growth ultimately leads to supernormal returns for companies and supernormal returns for investors over a period of time. Now, operating leverage can be a dangerous place to be when the economy is nosedive. So it can create a negative operating leverage, which could be quite nasty. And I think, a lot of people who deal with mark to market would appreciate how last year has been. In the context of going forward, though, with regards to where Indian economy is, I think structurally over the next 4 or 5 years, as the upturn happens, there is a natural tailwind for the economy. On top of that, if you have market share gainers, you amplify that by higher earnings growth over a period of time. And that's what we are looking to play. More with regard to the listed market space today, this is a good avenue where we look into, through this lens, the cyclical industries like industrial, like autos, like cement, where if we can hold on to, first find the market share gainers and hold on to them, trust me, the alpha generation becomes easy. Well, I would say simple, but not easy.
Right, Trideep. Coming to the third theme quickly, and which is innovators, and it's an entire gamut of things, very vast topic. But from your perspective, and especially from this fund perspective and India perspective, what kind of innovators today you believe are maybe the mega trends of the change, or catalyst to the change, and what kind of businesses currently you're holding under this innovators/innovation as a theme?
I have got to say this. I've got to say this, that overall, when we designed this fund, I had the ambition, and I still have, that at some point I could own some of the global businesses in this fund. And actually, when we designed this team, I did have that sort of an example in mind. To be brutally honest, in India, we don't have the true innovators. And the reason is that at the end of the day, it's a capital-starved country where
Right.
capital is tough to get. Entrepreneurs don't have come with whole amount of capital that they can invest and wait for decades. Maybe some families like Tatas and Birlas can do so, but they're hardly few. Majority of the capital, is still hard earned. So the true innovators are really globally. But in the Indian context, what we have are the players who generate nuts and bolts for this innovation. And trust me, that the typical Indian jugaad way, that is a good way and sustainable way for making money. The reason is that think about, you seem to have a nice haircut. Hence, I take that example. Let us say if you were to choose between two investments, one to invest in a hairstyle, and second to invest in a barber, right? Now, a hairstyle is a bit like an innovator. Now, whether that hairstyle goes through or not, or the beard style goes through or not, changes over time. I'm sure you would realize and appreciate. But on the same time, the barber always has a job because irrespective of what hairstyle it is, you would still have to go to him to get the stuff done, unless of course you do it on your own. Uh, so net, the risk-adjusted way of playing innovation is to own the barbers, if I may use that word. The barbers, those kind of businesses, you find quite a few in India. The IT services is a good example of that. Now, for instance, of course, today is a bad day to talk about IT services, or maybe the best day to talk about IT services. But overall, I would say that, I was listening to some of the earnings call. Um, People were worried whether AI would take away their jobs, this, that, the other. Now, when I listen to what TCS said on the call, is that, hey, I mean, maybe some part of our offering will get taken away, like testing or BPO, but we are generating a significant amount of projects where the clients are coming to us and asking to generate, to make their offering AI enabled. So, in other words, that while there is disruption, there is another part of their offering which they are benefiting from the same. Now, this is a classic barber-like situation that irrespective of which business, whether it is getting disrupted or they benefit from disruption, they can orient themselves very easily to sort of, generate revenues and profitability. This in the index context is what I mean by innovation. Take another example, auto ancillary. Now, as I was talking about that autos are going through a disruption of a century. EV is a meaningful disruption, whether you like it or not. Some of the traditional auto names globally have really kind of, had a hard time avoiding bankruptcy while going so. Now, think about the auto ancillaries in the context of India. Whether they service Tesla or whether they service Volkswagen or Ford, it doesn't really matter. Whosoever succeeds, they can kind of, still make money and bring the money back home. This is what I mean by a low risk way of playing innovation. Uh, in the third theme, as long as we own Indian businesses, this is where our focus is. And over a period of time, if with a kind eye of yours and the regulators, if we do get to own a few global businesses, then we can explore those as well.
So, Trideep, today, some of the examples you've mentioned, auto ancillaries, some IT companies. Is it safe to say that these are the some themes which you are currently playing in your portfolio within this theme?
Yes, absolutely. I mean, for instance, when we talk about a company in our portfolio, Motherson Sumi Wiring. Now, basically, the wiring content in the EV vehicle goes up 20-30% as compared to ICE vehicle.
Right.
So their sort of attachment rate to an EV vehicle is meaningfully higher than where they are. Now, their existing offering is ICE engine, which is normal in the engine. So that revenue continues. Whenever EV happens, whenever that pickup happens, they would stand to benefit from that. Isn't there a nice place to be? That is why that is one of our portfolio holdings. And again, by all means, kind of, bear in mind that our holdings are subject to the price that we own and hence should not be taken as recommendation. But when we own this business in our portfolio, this is what we thought through and it has certainly helped us make money. I think if I recall, we made about 30-40% return on the stock overall. Again, past returns, no example of future returns, but that's one of the structural thesis why we like it.
Just extending this, this theme as well. When we talk about innovators and disruptors, there's a lot of debate on how the new age companies come into picture and how they are disrupting the old businesses. How do you see this space? Because at least I haven't seen any of these kind of companies in your portfolio, but they are known for innovators and disruptors. So what's your thought on that?
It's the gray hairs, Niranjan, that maybe I think when I avoided them at the time of the IPO, a lot of people pointed to the gray hairs that I have, saying that you're going old school, man. But I think the old school part of it is still applicable, which is if business has to make money, number one. Number two, it has to have or it has to have a path to make money, or it has to have a path to profitability. And third, if we sort of have companies which are at the peak of earnings, and when they came for IPO, because all of us we were kind of behind our closed doors in our homes, and they came at significantly higher valuations. There is hardly any sort of margin of safety, and that is why we have avoided them. But that is not to say that we are turning a blind eye towards. I think if some of those tick boxes that I talked about are met, we are certainly open to owning them at the right valuation. So at the right price, at the right valuations, as the fair framework would say, Niranjan.
Thanks, Trideep. Just extending our portfolio construction strategy, and while you talked about multiple ways to look at business profitability, I will come back and ask you to describe more on our framework, which is fair. But before that, we always talked about this fund as a sector agnostic portfolio. You will find some skewness in terms of sectoral allocation versus benchmark, and also versus peers. So how is the sectoral allocation today in the portfolio, and which sectors are you overweight? Of course, within these sectors there will be some stocks which you will be playing as brands, market share gainers, or innovators. But when we look at the overall portfolio, this also matters, and that is what helped you also to generate an alpha for within a very short period of time. I mean, 2% alpha is unheard of. In this kind of market, especially when, of course, our focus strategy is meant for that, as you mentioned. But how is the portfolio today positioned in terms of sectoral allocation?
So I think our primary driving factor of how we go about selecting stocks is a function of the themes that we talked about, the three themes that we talked about, and at what price they're available to us in a nutshell. And some sectors naturally orient themselves very well to these themes and some not so. So we would probably never be significantly overweight in utilities, regulated utilities, or for that matter, maybe kind of, commodity, by virtue of the fact that we want to sort of, play brands and maybe innovators, maybe in some of the cyclical or market share gainers, commodity owners might actually kind of fit in, but to a lesser extent it's one of the three themes, right? So overall, hence there will be a bit of sectoral bias. What we intend to do in this portfolio, Niranjan, is to make the stock specific hypothesis play out meaningfully over a period of time. That's what we have done, and that's why it's generated alpha and will continue to do so. For instance, we realized that within the IT services, right, about a couple of months ago, and this is public knowledge, so no insider information, that about 3 or 4 important people in one of the leading companies left, like Infosys, and at the same time there was a new CEO in the case of TCS which joined. And we thought that since we can own 30 names, we always kind of choose where the investment hypothesis is better. Both are in the similar sector. We actually kind of moved on from Infosys and switched on to TCS. And look at a day like today. It happened to work in our favor quite nicely, where one of those businesses saw a material downturn and the other kind of chugged along. So I mean, extreme volatile day, but net stock selection helps. Where the bottom-up hypothesis works, owning that particular name helps. And number 3 overall, looking at bottom up rather than top down, which is IT services, also helps. So in this example, hopefully I've given you a bit of a thread onto how we go about selecting stocks, predominantly driven by our bottom-up hypothesis rather than otherwise.
Right, Trideep. And, I can, again, it would be a fair assumption to make that, even the market cap allocation is not consciously targeted at, but it's basically an outcome of all your bottom-up ideas. Now, I think so it would be a right time to also talk about our fair framework. You talked about bottom-up stock selection in each sector. But what is the overall philosophy which we, deploy while picking up stock in all of our funds, and especially this fund?
So I think overall, I would say that it's a combination of 4 pillars, and we call it FAIR. And thanks for helping in coining that name. Overall, the 4 investment pillars hover around forensic, acceptable price, I as in ESG informed, and R as in robustness. FAIR, fair investment philosophy. And it is, in my opinion, the fairest way that we could think about of picking stocks. If I were to sieve a sort of necklace out of these 4 investment principles, here is how I would say that we are bottom-up stock pickers. We are interested in financially clean companies that come out of a forensics analysis. We are interested in companies that can grow sustainably and have robust business models. This is the ESG informed, and the robustness part is the return ratios are higher than cost of capital. And finally, they should be available to us at an acceptable price, which is a margin of safety of 20% or better. Now, when I say this is in a sense what we do in, day out. You might argue that many people say this, but I would say that within these 4 important pillars.
Trideep, sorry, you have gone mute.
If you look at what we do in the case of forensics, is particularly worth noting, because overall we can see that what we look here is going beyond the P&L, balance sheet, and cash flow, trying to understand if there are any telltale signs that the company has left behind if something is going awry. It gives us a warning sign lot before the incident really happens. And particularly in focus strategy, where the number of stocks are limited, or some of our other flagship strategies wherein the number of stocks wherein we are mid cap or small cap strategies, I would say this company becomes particularly handy. I think as part of my investing career has been overseas. This as an area is probably underinvested in Indian asset management industry, and we certainly want to do more here over a period of time. As a niche AMC, we have a dedicated resource in that direction, and we plan to do that more religiously going forward. Likewise, our valuation discipline in the form of acceptable price or our fascination toward return are also particularly things to go for. So on net balance, we are bottom-up stock pickers oriented around these areas is what we do.
Right. Audience, we will be opening up for question and answers. So if you have any questions, do shoot in your questions within the chat window, and we'll be more than happy to answer all your questions today. Okay. Yeah, Trideep. Okay. So, Trideep, we've just had a full year earnings season concluded for FY23. We have just started to see the earnings coming up from some of the IT companies and all. So how is the earnings for your portfolio, especially focused equity fund portfolio, and what are the expectations over the next 1 year or so?
I must admit, with a bit of skill and luck, we got the recent result season in IT right so far. In terms of stock selection, as I was highlighting, we moved on from Infosys to TCS, and that helped us in good stead today. But I think this is a very short-term data point, which I think investors should draw comfort from. That ultimately we pay attention to when bottom-up drivers of the companies change. we are willing to change along with it. But overall, from a result season standpoint, our portfolio construction is more medium term, where overall our overweight in industrials, our overweight in direct and indirect plays in real estate, our overweight in lending financials are certainly three broad-based overweights that we have in the sectoral scheme of things. In answer to your earlier question, Niranjan, which I forgot to answer, and two very incipient themes. One is basically indigenization of defense that we are playing through our portfolios, and also kind of the China plus one strategy. So those would be the five themes across mostly manufacturing side of the economy, which is what we are overweight, and we are underweight the consumption side of the economy is our portfolio positioning. So in that context, if I look at the result season so far, another cut that I could provide of my portfolio is that we are overweight domestic stories and underweight global stories. So far, if you look at the numbers that have come about, we have seen the banking companies talk about their lending growth, which has been fairly robust. It points to good capital creation in the economy. We've also seen IT results come through, which has been probably barring today, not a disaster, broadly in line kind of numbers, which explains our sort of underweight stance or my underweight stance with regards to this sector and overseas focus sectors. We still have manufacturing companies yet to report. So I would say that so far so good. I think the results so far point to a buoyant domestic economy, and IT services point to the weaknesses in global economy is still intact. I would also say that between manufacturing and consumption, while consumption companies, Hindustan Lever reported, which were kind of weakish numbers overall, but the manufacturing side of the economy, if you look at the lending numbers, point to fairly robustness. So I think our portfolios are positioned the right way from a medium term standpoint, and hopefully the result season also holds us in good stead.
Right. So Trideep, I was about to end my questions, but you gave me cues and two more questions to ask. One is real estate. You talked about real estate, and it'll be great to hear your views on how the sector is playing out very quickly. Because we have a lot of questions coming in, but very quickly on real estate and defense and how you are playing.
So I think in real estate, we are actually going the indirect way more than the direct way. That's not to say that we don't do that. We don't play the direct way, but we find that building materials, tiles, etc., are a very good way to play the real estate sector as well. And our portfolio are replete with this name. I think Kajaria is the name that occurs from memory, where we kind of we have done quite well, and stocks like these basically. Defense, I think overall is a 10-year theme. We are probably, we don't have many choice to be today. And the choice that we have Bharat Electronics in our portfolio. We think that overall, as what was interesting to note is that some of these companies have their medium-term order books also full. And in that context, we think that we have a long road to go, road ahead to go through, and we think that defense is a good place to be. Niranjan?
Right. So Trideep, I think so we can start taking some questions from the audience. The first question is around, mostly all companies in the fund are appearing as established companies compared to any new emerging companies, and there's only a small allocation to small cap category. So why is it so is the question.
I think if you put together more mid and small cap, and if you look at what, I mean, look, at the end of the day, we have to generate outperformance versus the benchmark.
Right.
And hence, one of the things that we don't do too much is basically move around the benchmark classification and play around it. So when I look through the latest numbers and compare ourselves, our positioning versus benchmark on large and mid and small, I would say versus benchmark, we would be overweight mid and small cap as a category as opposed to large cap to the extent of about 400 to 500 basis points. So I think we do have a good round of mid and small cap names in our portfolio. I would probably say, I mean, for instance, one of the emerging brands that are there in the economy is overall which is there in our a lot of so it's about 4% in small cap. We have meaningful amount of allocation to mid cap, where we think they are not the smallest or tiny tots of the companies. Execution list is relatively limited, but at the same time, significant amount of runway is what they have in front of them. That's how I would categorize it. That versus benchmark, we would be overweight mid and small cap. So it's a good spot to be in sync with what we talked about earlier. As we go toward repower, people should be more invested in mid and small cap, but at the same time, not overdoing it, because we don't want to play the benchmark risk too much.
Right. One question, quite interesting one, is because of these three themes, would there be a very high?
So generally, our benchmark or sectoral calls are indices plus minus 5%. We think that overall that is a good place to be. It is not benchmark hugging, because plus minus 5% means that maximum alpha we could generate is 5%, which is good. But at the same time, not very close to the not very too away from the benchmark to guard against the question that was being asked, that could we have some years of fairly idiosyncratic underperformance. In the to answer the question, in the guidelines that we have struck, we have tried to minimize the risk that you ask, even though we try to do justice to the themes that we do. It's a tight balance that we follow. So far, we have been able to do so, hopefully going forward.
Right. The next question is broadly around the market, Trideep. So what are the near-term negatives which you can think of on the market, and also what are the positives?
I think the last 45 minutes have been positive. It's time we talk a bit about negatives, because and I think the one outstanding risk that I see in the next 1 year, and I am counting out those 4-5% market moves which can happen anytime. Don't ask me that. I mean, it could happen tomorrow, for all you know.
Right.
The one outstanding risk that I would highlight is basically the upcoming election middle of next year. I think while over the long term, elections don't really change India's course, but in the near term, you could see a few months of heightened volatility and north of 5% moves in the market if we were to sort of get a whiff that the macroeconomic stability that we have benefited from over the last 2 election terms is in jeopardy. And I think that is one risk which investors should keep an eye on and be mindful of overall. We note that there are 3 regional elections heading into the year end, which is why we are recommending to investors to, no matter how bullish they are on the medium term story, to still go with the tranches allocation, the STP allocation, rather than the lump sum allocation over this time frame. So that's one risk that I would certainly highlight. I think from where we are, where oil is at meaningful low price, a certain volatility or higher oil price over the next 1 year could certainly be a risk, which could kind of positively or negatively impact the inflation from a portfolio standpoint. That would be the second risk that I would kind of point to. And third is basically the geopolitical risk, which is kind of which can happen from anywhere, given that most of the governments these days are nationalistic. So those would be the 3 potential negatives that may come around. I am relatively more sanguine about the earnings that are likely to come. I don't think this result season we will see an utter disaster overall, but it will be broadly in line, maybe 2 or 3% cuts or 2 or 3% increases, which I call it broadly in line in the grand scheme of things. So the risk is more macro. The risk could be global, and local elections is what I would point to middle of next year. Niranjan?
Right. On election, Trideep, it's a Friday evening. Any views on the India, group which newly created?
So I think overall you got the wrong speaker for that. Radhika is the right person who can
Absolutely.
kind of
It was just for
talk
fun.
a bit about Mohandas.
Absolutely.
But I think I would say this, that the India's evolution will remain unaffected by elections. Don't get me wrong. I think
Right.
if we do get a volatility north of 5 to 10% in the case of election, it might be good time to people to add at those times for ones who have missed out. But nevertheless, it will cause volatility, is something that I think.
Right. Trideep, I think so. We have covered most of the questions. There are other questions which I think so you have already covered in terms of your sectoral views and all. Uh, I think so. It's a good time to end this. It's been almost an hour. A lot of thoughts you have shared on the portfolio, on the fund. Any final thoughts on Edelweiss Focused Equity Fund, and why do you think maybe 5 points why one should invest in this fund?
So I think overall, I would say that two parts to this. One is the asset allocation part. I think if we believe, and we certainly do, but if you believe as a listener that India over the next 3-5 years is going to be a part of a cyclical upturn, and generally, of course, there will be volatility in election, but the drivers that we see on a bottom-up basis, which we covered as part of this call, would be dominant over the next 5 years. Then, certain part of asset allocation should be allocated to those strategies where wealth creation happens and not just safety. And I think from that standpoint, the focus fund scores very well because we take calculated risk here. When I say calculated risk, it's clearly a concentrated portfolio, a 30 name portfolio, so it's higher on risk spectrum. But we are not taking the liquidity risk. We are going across market cap. Second, we are also playing the India's evolution over the next 5-10 years. So we are not trying to sweet time some short-term trends, and hence, the fund is rightly stuck, in my opinion. And third, with a lot of fluff, the tail being out of the portfolio, this is a good way to sort of make money on in a multi-cap way, particularly for investors who are evolved, who have been exposed to PMSs, and of course, cost of funds these days are a hot topic for discussion. This is a good place to be in the context of where India is in its evolution cyclically and structurally. Second, I would say that overall success begets success. I mean, close to 300 basis points of alpha, goes on to show that we can create alpha in this category. Of course, it's a short-term, one-year performance, but we hope to do, and past performance is by no means guarantee of future performance. But hopefully, the themes and the way we go about stock selection generates alpha over a period of time. That would be number two, which is the alpha generation capability of the strategy. And third, I would say that overall, if you were to think about the best ideas coming out of Edelweiss with 30 stock portfolio, naturally, the best ideas find their way into the focus strategy. So those would be the three that I would point to why investors should look at focus fund favorably over many of our competitors. Maybe two
Thank
for
you,
your
Trideep.
side, if you want
Thank
to
you.
add.
Thank you, Trideep. Thank you, everyone. Wish you all a great weekend ahead, and thank you for joining in us. I humbly urge you all to look at this fund. Trideep is putting a lot of effort, which we can see the alpha he has generated. Of course, past performance is not, may or may not sustain in the future, but this is very close to his heart, especially the brands and the themes which he talked about. And thank you again for being here. Happy weekend. Thank you, Trideep. Lot of wisdom shared. Thanks.
Thanks. I wish all of you a very happy weekend and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.